international investing, hidden gem markets, most Americans ignore. You know, I was looking at my neighbor's portfolio the other day. Nice fellow, works in tech, makes about $150,000 a year. And I noticed something that frankly disturbed me. Out of his $380,000 investment portfolio, you know how much he had invested outside the United States? Zero. Not a single dollar. And here's the thing that really gets me. He's not alone. The average American investor has about 75% of their stock portfolio in U.S. companies, according to Vanguard's 2024 Investor Behavior Study. Some folks? They're at 100%. Now, the United States represents roughly 25% of global GDP. Let me say that again. 25. So if you're putting 75% or more of your money into 25% of the world's economy, well, that's not diversification. That's patriotism masquerading as investment strategy, and it's costing you money. Here's what most people don't realize. This bias, economists call it home country bias, it's not just leaving money on the table, it's leaving compounding money on the table. And as Charlie Munger used to remind me, that's the worst kind of money to leave behind. Let me give you some numbers that might surprise you. Between 2000 and 2023, if you'd invested $10,000 exclusively in the S&P 500, you'd have roughly $43,000 today. Not bad. About 6.4% annually with dividends reinvested. But here's where it gets really interesting. If you'd taken that same $10,000 and split it, $7,000 in the S&P 500 and $3,000 in a diversified portfolio of emerging markets, you'd be sitting on approximately $52,000. That's $9,000 more from the same initial investment. Now, I can hear some of you thinking, Warren, emerging markets are risky. They're volatile. I've heard horror stories. And you're right to be cautious. But let me ask you something. Is putting all your eggs in one basket, even if it's a nice American basket, really less risky? The math says otherwise. See, we Americans have this notion that international investing is somehow exotic, complicated, dangerous even. But think about it this way. When you buy an iPhone, where do you think the profits come from? Sure, it's an American company, but Apple generates about 60% of its revenue outside the United States. When you invest internationally, you're just cutting out the middleman. Now let me tell you about 3 markets that most Americans completely ignore. And I'm going to show you why that's a mistake, not just with theories, but with actual mathematics and real-world examples. First up, Vietnam. I know what you're thinking. Vietnam? Really? But hear me out. Vietnam's economy has been growing at about 6-7% annually for the past decade, nearly double the U.S. rate, according to the World Bank. The population is young, educated, and increasingly middle class. About 70% of Vietnamese citizens are under 35 years old. But here's the part that really caught my attention. The Vietnamese stock market, the VN Index, is trading at an average PE ratio of around 11 to 12. Compare that to the S&P 500's current PE of about 25. You're getting earnings at literally half the price. Let me put that in concrete terms. Say you invest $5,000 in a Vietnam-focused ETF like the Van Eck Vietnam ETF. Over the past 10 years, despite all the ups and downs, that investment would have grown to approximately $11,500. That's a 130 return. The same $5,000 in the S&P 500, about $9,800, still good. But you left $1,700 on the table. Now, the psychological barrier here is obvious. Vietnam feels foreign, unfamiliar. But Coca-Cola, Nike, Intel, they don't feel that way. They've been doing business in Vietnam for decades. They've done the homework. Maybe we should too. Second market, Poland. I love Poland for one simple reason. It's boring. And in investing, boring usually means profitable. Poland is the sixth largest economy in the European Union. It's got solid infrastructure, a well-educated workforce, and it's been quietly growing at 3 to 5% annually while much of Europe has been struggling. But here's the kicker. The Warsaw Stock Exchange is trading at valuations about 30 to 40% below Western European markets. According to MSCI data from 2024, Polish equities have a PE ratio averaging around 8 to 9. Think about that. You're buying European quality at emerging market prices. Let me give you a real example. PKO Bank Polski, it's Poland's largest bank. It's profitable, it's well managed, and it's been paying dividends consistently. Over the past 5 years, it's returned about 85, including dividends. Meanwhile, similar-sized European banks, they've been treading water, returning maybe 20–30% over the same period. That's a 55 percentage point difference from one stock. In a country that most Americans couldn't find on a map. Third market, South Korea. Now, you might know Samsung, you might know Hyundai, but what you probably don't know is that South Korean stocks trade at what's called the Korea discount, about 40–50% below comparable companies in the US or Japan. Why? Mostly fears about corporate governance and North Korea. But here's what I've learned in 70+ years of investing. Fear creates opportunity, always has. Samsung Electronics, for instance, the world's largest memory chip manufacturer, trades at a PE ratio of around 12 to 13. Apple, by comparison, trades at about 30. Both are phenomenal companies. Both print money, but one costs half as much. If you'd invested $10,000 in South Korea's KOSPI index in 2014, you'd have roughly $15,800 today. The dividends alone would have paid for a nice vacation every year. But this is where it gets really interesting. South Korea is aging rapidly. The government knows it needs to attract foreign capital, so they've been implementing reforms, improving corporate governance, increasing dividend payouts. In other words, the very reasons for the discount are disappearing. But the discount, still there. Now you might be thinking, Warren, this all sounds great, but how do I actually do this? I don't speak Vietnamese or Polish or Korean. And that's exactly the psychological barrier that keeps 75% of American money locked inside our borders. But here's the thing. You don't need to speak Vietnamese to invest in Vietnam. You just need to understand value. And value speaks a universal language. It's called mathematics. You can buy a single ETF, something like the Vanguard FTSE Emerging Markets ETF, or the iShares MSCI SUEIX US ETF, and instantly own pieces of thousands of companies across dozens of countries. One transaction, same brokerage account you already have. No passport required. The real shift isn't logistical, it's mental. It's going from I invest in what I know to I invest in what makes mathematical sense. It's recognizing that Coca-Cola doesn't stop being American just because half its customers live overseas. And a Vietnamese company doesn't become foreign just because its headquarters aren't in New York. Now, I know some of you are thinking about currency risk. What if the dollar strengthens? Won't I lose money? Fair question, and yes, currency fluctuations can affect returns. But think about it this way. If the dollar strengthens, that usually means the U.S. economy is struggling relative to others. In that scenario, wouldn't you want some money in currencies and markets that are performing better? Diversification isn't just about spreading risk across companies. It's about spreading risk across economies, across currencies, across political systems. Because, and I say this with all the patriotism I possess, no empire lasts forever. Rome didn't, Britain didn't, and the United States, magnificent as it is, won't dominate the global economy indefinitely. That's not pessimism. That's just math and history having a conversation. So here's what I'd suggest. Start small. Take 10% of your equity portfolio, just 10%, and put it into international stocks. If that makes you nervous, make it 5%. Use low-cost index funds. Vanguard, Schwab, Fidelity. They all offer international ETFs with expense ratios under 0.1%. That's basically free. Rebalance annually. When international stocks do well, trim them back. When they lag, add a little more. And most importantly, be patient. International markets don't move in lockstep with the US. Some years they'll lag. Some years, they'll soar. Over the long run, you're reducing risk and very likely increasing returns. I've been investing for over 70 years now. And the single biggest mistake I see people make isn't picking the wrong stocks. It's not trying to time the market. It's thinking too small. The world is a big place. 7 billion people, hundreds of economies, millions of companies. And the best opportunities, the ones that'll make you wealthy over the next 20 years, they not be in Palo Alto or New York. They might be in Ho Chi Minh City or Warsaw or Seoul. The question is, are you going to find them? Or are you going to let 75% of the world's opportunities pass you by because they feel unfamiliar? I know what I'd do. I've been doing it for decades. Now it's your turn. Think about it. Do the math. And maybe, just maybe, take that first step outside your comfort zone, because that's where the money is. Thanks for watching.